So Victoria's Secret just dropped their third quarter results, and really, the big question on everyone's mind is this: is the turnaround finally for real? For years, the story has been one of struggle, but these latest numbers, they seem to be telling a completely different story. Today, we're going to dive deep into all the financial data. We're talking sales, profits, their future strategy, the whole shebang, to see what the numbers are truly telling us about the health and direction of this iconic brand.
Okay, let's start right here. The entire narrative for this quarter is pretty much framed by this single quote from the CEO, Hillary Super. Now, words like standout and outperformance, those aren't just empty corporate buzzwords. Nope, they are a clear, deliberate signal that the company's leadership truly believes they are turning a critical corner. So our job in this explainer is to kind of be investigators, right? To look past the headlines and dig into the hard data to see if that very optimistic story really holds up under scrutiny.
And here it is. This is the headline number that got everyone talking: a 9% year-over-year increase in net sales. Now, you got to understand, in the hyper-competitive world of retail, a high single-digit growth number like this is significant. It's a really big deal. For a mature brand like Victoria's Secret, which has faced some serious headwinds and a lot of questions about its relevance, achieving this kind of growth, well, it's the first major piece of evidence that suggests something fundamental might be changing inside the business.
To really get the full picture, we've structured our deep dive into 6 key parts. First, we're going to establish a baseline. What exactly is Victoria's Secret & Co. today? Then, we'll dig into that top-line sales growth. After that, we're going to tackle the profitability puzzle, to ask if that growth is actually making them any money. We'll check the company's overall financial health through its balance sheet, and then review management strategy, which they call the path to potential. And finally, we'll pull it all together for our final verdict.
So, let's start with the fundamentals. Before we can even begin to properly analyze the numbers, we need to be crystal clear on what the company does, what brands it owns, and how it operates on a global scale. You can't really get the numbers if you don't get the business, right?
At its core, Victoria's Secret & Co. is a specialty retailer built around 3 distinct brands. You've got the flagship Victoria's Secret, the younger-focused Pink brand, and Adore Me, which is a digitally native and size-inclusive brand they bought to modernize their portfolio. Their product range is broad, but the real story of their scale isn't just in the stores they own. Look at their global footprint. They've cleverly expanded their reach through over 540 partner-operated stores in 70 countries. This franchise model is a really savvy move. It lets them grow internationally with a lot less risk and less capital, which is a key piece of their global strategy.
All right, with that foundation in place, let's get into the most watched number for any retailer: sales growth. This is what's known as the top line of the income statement, and it's the first and most basic test of a company's health. It's a simple question: are customers buying more or less than they were before?
Here's that 9% growth in action. You can see sales climbing from roughly $1.35 billion to over $1.47 billion. But listen, the number itself is only half the story. The real kicker here is that management had previously told Wall Street to expect sales somewhere between $1.39 and $1.42 billion. They didn't just meet expectations, they blew right past them. For investors, this is a huge signal of confidence. It suggests the business has this positive momentum that even the company's own forecasters underestimated.
Now let's just pause for a second and define this term properly, because it's really important. When we say net sales, we're not just talking about the sticker price of everything they sold. No, this is the revenue after you account for all the messy realities of retail: customer returns, discounts from all those promotions, and allowances for any damaged goods. It's the true, clean measure of the money that actually came in the door from selling products, which is exactly why it's the very first line, the top line, on an income statement.
So where did that $1.472 billion in sales actually come from? This slide breaks it all down. The majority, 53%, still comes from their physical stores in North America. The direct or online channel makes up another 29%. But look at that international slice. It grew by a massive 34% year over year. Wow. This is a huge driver of the overall outperformance, and it shows that strategy of expanding through the partnership model we just talked about is really paying off. This also suggests there's strong demand in new markets, which is a crucial source of growth as the North American market matures. Now, for what might be the most important sales metric for any retailer: comparable sales. This number strips out all the noise from opening new stores or closing old ones. It just asks a simple, really powerful question: are the existing mature stores and websites selling more than they did last year? And the answer here is a resounding yes. An 8% increase tells us their core business is getting stronger. It's not just about opening more stores, it's about making their current stores more productive and getting existing customers to spend more. That is a fantastic sign.
Growing sales is great, but it's only half the story. A company can easily grow itself straight into bankruptcy if it's not profitable. So the next crucial question is, of that $1.47 billion in revenue, how much did Victoria's Secret actually get to keep? This is the profitability puzzle. They're selling more, but are they actually making more money on each sale? Let's find out.
Before we look at profit, you have to understand that companies often report their results in two different ways. On the left, you've got GAAP. That stands for Generally Accepted Accounting Principles. Just think of this as the official, audited, by-the-book number that follows all the standardized rules. Then, on the right, you have adjusted or non-GAAP numbers. This is where management takes that official number and pulls out certain items they think are one-time events or not related to the core business to show what they believe is a clear picture of performance. It's not the official number, but it's often management's preferred story.
This table shows you exactly how they get from one number to the other. They start with the official GAAP operating loss of $19.1 million. Then they add back several things. $6.3 million for amortization, which is just a non-cash expense, kind of like depreciation but for intangible assets. Then they add $6.9 million for restructuring, which are one-time costs like severance for departing executives. And finally, $5.9 million for costs tied to that Adore Me acquisition. When you make all those adjustments, that $19 million loss magically turns into zero, break even. This is how they get from the official number to the one they want you to focus on.
And the reason they want you to focus on it is because it tells a powerful story of improvement. Now, I know break-even might not sound amazing, but context here is everything. Their own guidance was for an adjusted operating loss between $35 and $55 million. So they absolutely shattered those expectations. And when you compare it to last year's adjusted loss of $28 million, it represents a really significant turnaround in their underlying profitability.
So how do they pull off that massive profitability beat? Well, a big part of the answer is right here, gross margin. This is just the percentage of revenue a company keeps after paying for the goods it sells. An increase of 170 basis points, which is just Wall Street speak for 1/100%. So 170 basis points is simply 1.7 percentage points. That's a huge deal. It means that for every single dollar of sales, they kept 1.7 cents more as gross profit. And the company said this was driven by fewer promotions. That's a critical sign of brand health. It suggests customers are willing to pay full price, which strengthens both the brand and its bottom line.
Finally, we get to the bottom line for shareholders, adjusted net loss per diluted share. After all the expenses and all the adjustments, the company lost 27 cents per share. But again, the real story is the beat. Management's guidance was for a loss somewhere between 55 and 75 cents per share. This result just shows strong operational control throughout the entire business, from the top line all the way down to the bottom. Okay, so we've seen strong sales and surprisingly good profitability. But the income statement is really just a story of a period of time, like a movie. To understand the company's true financial foundation, its ability to withstand shocks and invest in the future, we need to look at its balance sheet and its cash flow. That's more like a photograph.
The balance sheet is exactly what it sounds like. It's a financial statement where two sides have to balance. On one side, you have everything the company owns, its assets, things like cash and inventory. On the other side, you have everything it owes, its liabilities, like debt. The difference between what it owns and what it owes is the shareholder's equity. Just think of it as a snapshot, a financial photograph of the company's net worth on a single day.
Looking at their balance sheet, the most important takeaway is that the company is solvent. As you can see, their total assets of $5.1 billion are greater than their total liabilities of $4.4 billion. That difference, that $700 million in shareholders' equity, is a fundamental sign of financial stability. It means that even if they had to pay off all their debts tomorrow, they would still have assets left over, and that's a good place to be.
Now, one specific line item that analysts always watch really closely is inventory. At $1.38 billion, it's up from last year. And, sometimes a big jump in inventory is a red flag. It can suggest the company is making things that just aren't selling. However, given the strong 9% sales growth and management's really optimistic outlook, this increase looks more like a strategic bet. They are consciously stocking up their shelves because they're anticipating a very busy and successful holiday season.
The final piece of our health check is the cash flow statement, and this one can be tricky. Its main job is to find the real cash a business generates, which can be different from its accounting profit.
As this slide shows, you start with the official accounting loss. Then, you do something kind of interesting. You add back expenses that didn't actually use cash, like depreciation on a building. Next, you adjust for changes in working capital. For instance, if the company spent cash to build up that holiday inventory, you'd subtract that here. After all these adjustments, you finally get to the most important number, cash from operations. This is the true lifeblood of the business.
So for the year so far, they've used $174 million in cash for operations, and a big part of that was for that inventory buildup. They also used $163 million for investing in things like store renovations. So you might be asking, if they spent cash on both, where did they find it? Well, the answer is financing. They generated $360 million by borrowing money. Essentially, they took on debt to fund their inventory and store improvements. While this is pretty common for retailers heading into a big season, it's something to watch. It's a bet that they can generate enough cash from holiday sales to pay that debt back.
We've analyzed the past quarter from just about every angle. Now, let's turn our attention to the future. What is management's plan to keep this momentum going, and what are they telling investors to expect next?
The company calls its core strategy the path to potential. And in their investor materials, they detail 4 key pillars for growth. First is supercharge our bra authority, basically doubling down on their core product. Second, recommit to pink, revitalizing their youth-focused brand. Third, fuel growth in beauty, expanding their powerful fragrance and body care business. And fourth, evolve our brand projection, which just means continuing to modernize their marketing and their image. This is their public roadmap for growth.
And right here, you can see their confidence in that roadmap. Following this strong third quarter, management significantly raised their forecast for the entire year. They lifted their net sales guidance, and more importantly, they substantially increased their outlook for adjusted operating income and adjusted earnings per share. Raising guidance across the board like this, well, it's one of the strongest signals a management team can send about their belief in the business's positive trajectory.
Okay, we've gone through the business, the sales, the profits, the balance sheet, and the strategy. We've looked at every single piece of the puzzle. Now it's time to put it all together and give our final verdict based on all the evidence in these documents.
Based on a thorough analysis of the Q3 results and management's outlook, our conclusion is that the financial condition and performance of Victoria's Secret & Co. is definitively improving. But a verdict is pretty useless without the reasons behind it, so let's lay out the 3 distinct, data-driven pillars that support this conclusion.
The first reason is just the sheer strength and quality of the sales growth. A 9% increase that beats their own guidance shows powerful, positive surprise. Critically, the CEO confirmed this growth wasn't just in one area. It was broad-based across all their key brands. And finally, that really robust 8% comparable sales growth proves that the core existing business is gaining momentum, which is the most critical indicator of a healthy turnaround.
The second reason is the massive beat on profitability. Reporting break-even adjusted operating income when a significant loss was expected is a huge operational win. It was powered by that 170 basis point expansion in gross margin, proving they can sell more products at higher prices. And this discipline flowed all the way down to the bottom line, with an earnings per share result that wasn't even in the same ballpark as the loss that was forecast. That just shows they are managing the entire business effectively.
And our third and final reason is the tangible increase in management's own confidence. Actions speak louder than words, and by raising their full-year financial targets for every key metric, they are putting their credibility on the line. This action, combined with the CEO's decisively positive tone, sends a powerful signal. They believe this isn't just a one-time good quarter. They believe the momentum is real and sustainable heading into the most important shopping season of the year.
So that brings us to the final, forward-looking question. The third quarter was, by all measures in the data, a standout success. The numbers show real momentum, and management has laid out a clear path to potential. But the ultimate challenge still remains. Can they transform this single positive quarter into the beginning of a long-term, sustainable comeback story for one of retail's most iconic brands? That is the question the market will be watching.